Hello, hope things are going fine. Now, we have to talk about something of extreme importance. And in most of the cases, it's a blind spot for so many managers, whether they are from a financial background and sometimes from a non-financial background, most of the cases, yeah. Now, there is something called the economic profit. What is the economic profit? Most of you are acquainted with what is called the accounting profit, the normal profit that you can see in the P&L, in the profit and loss account. Revenues minus your costs will generate profits. You need to increase this level of profits, increasing the profit margins, the profit to revenue, the return on investment, the profit to the assets, return on equity, profit to the shareholders' money, equity money. All these are very nice. But there is something very important called the economic profit. When you achieve the economic profit, you probably so near to generate what is called value creation to the shareholders, making the business bigger, more valuable, probably impacting the share price in a positive way. What is the difference between economic profit and accounting profit? A lot of differences. But what we are going to talk about now is the issue of how the financial statements talk about finance cost. The financial statements mention only finance cost, which is the interest on the loans. They never mention the economic cost of the shareholders' money in the business because it is not done in a deal. Yani you don't have a deal between the management of the business and the shareholders that you will pay them a certain dividends, fixed dividends every year. No, it is not obligatory at all. It depends on the conditions of the market. So accountants could not quantify a number of cost of equity and put it as a cost of finance in the profit and loss account. So they don't put it. They only put interest expense. But in reality, in order to make profit, it has to be more than the required return by the financiers, whether they are from the debt side or from the equity side. This is the economic profit. How we quantify for it? We quantify for it by a model called the EVA model, the economic value added model. You start by getting your operating profit after tax only, not after interest and tax, because you are going to deal with your finance cost in the way of, as we have explained before, in the way of the cost of capital, the WACC, the weighted average cost of capital. Now, you have operating profit after tax, which is the operating profit, the EBIT, times 1 minus T. In our case, for 2002, for example, in our case here, okay, operating profit was 303. You multiplied it by 1 minus 20%, the tax rate in our case. So this is the what we call the NOPAT, the net operating profit after tax. Then you calculate the capital employed, the assets minus accounts payable and accruals. This was its result. And you calculate your cost of capital, your cost of finance. We saw that earlier, the weighted average cost of debt and equity. Then you get what is called the capital charge. You get what is called the capital charge. It is the cost of finance multiplied by the capital employed. Then the last thing to do is you get your NOPAT, your net operating profit after tax. You take it and you deduct it from the capital charge, which is the minimum amount of return that you have to achieve for the financiers, the debt and the equity holders together, not only the debt holders, not only the people who are lending you, no, and also the average required rate of return that the shareholders want on their money. All right. The result will be something called the economic profit or the economic value added, the EVA. When it's negative, make sure that this level of work, this level of profitability, this level of revenue and operating profit will not satisfy the shareholders' value creation. You are not adding wealth, real wealth, to the shareholders. It has to be a positive number. It is very important to know that this number, this EVA, this model, will help us to put plans for the future. How can we put a revenue target, a profit target that can, by achieving it, generate positive economic value added? Of extreme importance to know the difference. Thank you very much. Have a nice day.